Welcome to the Deep Dives. We're the show that digs into the details to help you stay informed. Today, we're tackling a really big question, I think. What does it actually take to build a company that lasts? Not just survives, but, really thrives for the long haul in this constantly changing world.
It's a fundamental question, isn't it? Especially now.
Exactly. And our mission today is to get beyond just the financials. We're doing a deep dive into the Markel Corporation's 2019 annual report, specifically the letter they wrote to their business partners.
Which is often where the real gold is in those letters.
Right. So this isn't just about their record numbers in 2019, though we'll touch on those. It's about understanding their philosophy, their strategic engines, their whole long-term vision, how they play what they call an infinite game.
Mm-hmm.
We want to unpack how they managed that growth, navigated some pretty big challenges, and really laid the groundwork for what looks like long-term resilience.
Yeah, and it's a great source. The annual report, particularly that qualitative narrative, gives you a real window into the thinking, the core values driving the decisions.
Yeah.
It's the why behind the what.
Okay, so let's start unpacking that. Markel's core identity. They state it right up front, their aspiration to build one of the world's great companies. And they plan to do it through the pursuit of excellence. Pretty bold.
It is bold, but what's fascinating, I think, is how they immediately connect it to this long-term win-win-win approach.
Right.
It's not just about the shareholders. They explicitly say customers, employees, and shareholders, everyone has to win.
Which ties into that infinite game idea you mentioned.
Exactly. It connects directly to James Carson's concept. The idea is if everyone's winning, the game can keep going forever. That's their stated desire. It's fundamentally different from just focusing on, say, the next quarter's results.
Yeah, a very different mindset. And central to keeping that game going is what they call the Markel style.
Ah, yes, the style.
Their sort of cultural blueprint, right? A dependable North Star, they call it, that unites all these different parts of their business, insurance, industrial stuff, services, investments. It's quite diverse.
It is. And they're honest about it. They say the style may not appeal to everyone.
Which I found interesting.
Yeah, but crucially, it strongly attracts those for whom it resonates. So it acts like a filter, creating a home for outstanding employees who are aligned with that core philosophy.
It really shows the power of having a clear, written culture, doesn't it? It becomes this magnet for the right kind of talent. A lesson there for any organization, really.
Absolutely. It defines who you are and who you want on the team.
Okay, let's shift to the 2019 highlights. The numbers themselves, they were pretty striking.
They were. Total operating revenues hit $9.5 billion. That's, up 39% from 2018? Big jump.
Huge jump. And comprehensive income, $2.1 billion, which was a massive turnaround from a loss the year before. Record highs, as they put it.
Definitely headline-grabbing numbers. But connecting this back to their philosophy, it's really important to see how they stress the 5-year view.
Right, they don't just focus on the single year. Why is that?
Well, they argue, and I think convincingly, that annual results can bounce around a lot, due to investment markets, big catastrophes hitting the insurance side, cycles in their Markel Ventures businesses.
So the 5-year number smooths that out.
Exactly. It gives a clearer picture of the underlying economic progress. They point out, for instance, total revenues for 2015-2019 were $33.4 billion, up 93% from the previous 5-year block. That shows a more sustained trend.
And it reflects how they actually think. They say, we think about what would be best for our customers and our employees over the long term. We're confident if we do that well, our shareholders will be pleased.
It's their guiding principle. Long-term thinking isn't just talk, it drives decisions. It's about strategic patience and genuine accountability over a meaningful time frame. They even tie management compensation to these longer-term metrics.
Okay, so how do they generate this progress consistently? They talk about their 3 powerful financial engines.
Right. Insurance, Markel Ventures, and their investment activities. All provided, as they say, positive thrust in 2019.
It's a strategy of specialization and diversification. Be experts, but spread the risk.
Precisely. That diversification within specialization is key to their resilience. They know some businesses might not be around forever, so they need to adapt and find new opportunities across these different engines.
Let's dig into engine number 1 then, insurance.
Okay. So the insurance side had a strong 2019 overall. Premiums written were $5.3 billion, up 12%. And importantly, their combined ratio improved to 93%.
Which means they're making an underwriting profit, right?
Yep.
Spending 93 cents for every dollar of premium.
Correct. A key metric. And within that, they have distinct parts, like Markel Assurance, their wholesale business, the crown jewel. Then Markel Specialty, which is fascinating, covers really niche markets. Things like horses, farms, camps,
Wow.
classic boats, cars, electricians, plumbers, even mom and pop restaurants. Highly specialized.
Shows that expert focus. What about internationally?
International, based in London mainly.
Huh.
Success there was a bit muted in 2019, partly due to a tough competitive market at Lloyd's, but strategically they've been expanding beyond London, Canada, Germany, India, Spain.
And they had that interesting example about Brexit, didn't they?
Yeah, using their German platform, which they set up way back in 2012, to navigate Brexit smoothly. It shows real foresight, building capacity before it was obviously needed rather than just reacting, finding great leaders and building solid local businesses.
Okay, then there's reinsurance.
Right, the reinsurance cylinder. $1.1 billion in premiums there. Combined ratio was 104%, which is still a loss, but better than the 113% in 2018.
And their strategy is different here, more opportunistic.
Very much so. They describe it like accordion bellows. When big losses hit the industry and others pull back capital, Markel sees opportunity and deploys more capital, expecting better pricing. But when capital floods back in and pricing gets soft, they pull back, reducing their writings. It's flexible, taking advantage of the market cycles, especially after those big catastrophe years in 2017 and 2018 pushed pricing up.
Makes sense. And the third part of insurance, the ILS and program services.
Yes, the insurance-linked securities and program services cylinder, these came mainly from big acquisitions. CatCo, State National, Nephila, they call them transformative. The goal is better, faster, and cheaper insurance solutions.
ILS is different because it uses outside capital.
Exactly. Instead of Markel putting its own balance sheet at risk, third-party capital, like pension funds, endowments, provides the risk capital. Markel manages the process, selects the risks, and earns fees.
But it hasn't all been smooth sailing there, right?
No, definitely not. They're very open about the painful bumps. CatCo in particular had severe losses from the huge catastrophes in 2017 and 2018. That led to regulatory inquiries, and Markel itself lost money as an investor in CatCo funds. As a result, CatCo stopped writing new business in mid-2019 and is now in runoff, basically just managing old claims until they expire.
So, a setback. But they also highlight successes in that area.
Absolutely. They contrast CatCo with State National, which is a leader in the regulatory and processing side for programs and ILS, and Nephila, which basically pioneered the ILS market decades ago and is still a top player.
So it shows resilience, learning from failures while other parts succeed.
I think so. It demonstrates that even with diversification, things can go wrong. But the overall strategy allows them to absorb those hits, learn, and keep moving forward with the parts that are working well, like State National and Nephila.
And the future for ILS.
They see consolidation, advantages of scale growing, and they believe ILS will move from being seen as alternative assets to just assets, fully mainstream. It lets them offer broader insurance solutions using other people's capital efficiently.
Okay, let's move to engine #2, Markel Ventures. This is the non-insurance part.
That's right, a diverse portfolio of industrial and service businesses. In 2019, Ventures brought in $2.1 billion in revenue and $264 million in EBITDA.
Which is pretty substantial growth from where they started.
Oh, huge growth. Back in 2005, it was just $60 million in revenue and $5 million in EBITDA. It's become a major engine.
And their focus here is cash money.
Yeah, that's their term. Over 15 years, they put about $1.9 billion into these businesses, and roughly $900 million has already come back as cash, either distributed or held internally.
How do they find these businesses? Their acquisition strategy seems unique.
It really is. They actively avoid auctions, which they see as a seller's market. Instead, they rely on their reputation.
How so?
They've built this image as quality owners with long-term vision, autonomous operating practices, embodying the Markel style. So business owners who care about legacy and culture apparently call them directly, principal to principal. That's how they bought companies like Costa Farms and CapTech.
That's fascinating. Makes you think, doesn't it? How building that kind of reputation, that culture, becomes a real competitive advantage in M&A. It's not just about price.
Exactly. It's about being the buyer of choice, offering a permanent home that fits that win-win-win philosophy. It lets them find good businesses, often family-owned, that want to continue growing within the Markel framework.
Okay, engine #3, investments. The 2019 returns were pretty eye-popping.
They really were. 30% on the equity side, 6.5% on fixed income. That gave a total portfolio return of 14.6%, their best in 24 years.
Whoa.
But again, true to form, they immediately put it in long-term context. Their 5-year equity return was closer to 11.7%, 10-year about 15.2%. Strong, but they emphasize consistency over single-year spikes.
And they have a clear process for picking stocks.
Very clear. A 4-part discipline they've used for years. Businesses with good returns on capital and not too much debt, talented management with integrity, chances to reinvest capital wisely and critically, buying at a fair price.
And fixed income.
That's more about stability. Matching their insurance liabilities with high-quality bonds. They aim for just a small, positive spread over their cost of funds, though they note the challenge of doing that with current, low, even negative interest rates, calling it a growing and troubling development.
Yeah, and this is where they sound quite cautious, despite the great 2019 returns.
Extremely cautious. They explicitly mention being wary of the Wild West environment in capital markets. They stress discipline and their long-term focus, especially given the unprecedented interest rate environment.
They basically say something is going to go wrong, even if they don't know what.
Right. They're not making predictions, but they are preparing by sticking rigidly to their investment discipline. Don't chase returns, don't compromise on quality or price. It's about preparedness.
It's a powerful lesson. Great returns are nice, but the discipline behind them, especially when markets feel frothy, is maybe more important long term.
Absolutely. How you make money and your readiness for bumps in the road.
Okay, so with these three engines generating capital, how do they decide where to put it? Capital allocation.
They have a clear 4-step triage, as they call it. First priority, reinvest in their existing businesses if there are profitable growth opportunities.
Makes sense.
Second, acquire new businesses, either for ventures or maybe insurance bolt-ons. Third, invest in public stocks through their investment engine using that 4-part test.
And the last option.
Repurchasing their own Markel shares. They did more of this in 2019, but only when they think the shares are trading below their estimate of intrinsic value. Always disciplined.
And speaking of value, they mentioned that how they measure their own value is changing. Book value isn't the best metric anymore.
Right. For years, growth in book value per share was a decent proxy for their progress. But now, with Markel Ventures being so significant, the ILS fee income, the share buybacks, book value just doesn't capture the full picture of the economic engine.
So how do they think about it internally?
They use a more complex, multi-part estimate of intrinsic value. Looking at normalized earnings power from insurance underwriting, from investments, from ventures, from the ILS fees, and subtracting expenses, all viewed over multiple years to smooth things out. It's about understanding the sustainable earning power of the whole enterprise.
Adapting their internal scorecard as the company itself evolves.
Precisely, which is crucial for making good capital allocation decisions.
So wrapping this all together, the philosophy, the engines, the discipline, it paints a picture of a company built to last. And this report pays tribute to someone key to that, Alan Kirshner.
Yes, a really significant figure. He retired as executive chair after 60 years with the company. Incredible tenure.
And they credit him as the primary author of the Markel style back in 1986. His contribution was systemic.
It's quite amazing when you think about it. One person's vision, codified in that style document, guiding 19,000 employees worldwide decades later. It allowed the core principles to scale far beyond his personal reach.
And there was that detail about the style itself.
Yeah, really insightful. The final word of the Markel style is winning, but the word insurance, their original business, isn't mentioned at all.
Wow. Foresight for diversification right there.
Incredible foresight. Even back in '86, he seemed to understand the company was fundamentally about service and winning, which could extend far beyond just insurance, long before Markel Ventures was even a thing.
And his legacy extends beyond the company too, doesn't it?
It does. He was very involved in the community, founding Partnership for the Future to help high school students get to college, and the Faison Center for Children and Adults with Autism. So a dual legacy.
Right.
Building the win-win-win company culture and contributing significantly outside the company walls.
It really underscores how one person's principles can shape an organization's trajectory for decades, financially and culturally.
Absolutely. The Markel style wasn't just words. It was the operating system that allowed for consistent values across immense growth and change.
What a fascinating look inside the Markel way. It seems clear Their success, those 2019 records included, really flows from that core philosophy, the diversified engines, the disciplined capital use, all aimed at that infinite game. They navigated challenges not just by reacting, but by having this foundation.
Exactly. It shows that resilience and adaptability aren't just slogans. They have to be built into the very fabric of the company through values and strategy, like Markel's blend of specialization and diversification and their focus on long-term cumulative results.
Markel's story really shows how having these deeply ingrained values, this style, let them anticipate and adapt to big shifts like Brexit or the rise of ILS as alternative assets well before they hit the mainstream. It kind of makes you wonder, doesn't it? What foundational style or core principle could you define today that would guide your decisions for the next, say, 60 years? How would that ensure resilience and growth, whatever the future throws at you?